Hello, everyone. I'm Mark Curry, co-founder of SMK Capital Management. I'm going to share with you a few relevant tailwinds and market trends that we're seeing today in the real estate market. And I'm also going to review why our investment strategy and outlook remains bullish on affordable housing and apartment investments, even though asset prices continue to climb. We recently published an article. It's called "We Have Entered a New Market Cycle." If you haven't seen it yet, take a look at our website. It's right under the Learn button. It really dives into a lot more detail, but let's start with a very important point. In June of 2021, a significant gap between the supply and demand for housing was noted, and it's actually noted that the United States has a deficit of over 5.5 million units of housing. Meanwhile, the demand for apartments specifically reached an all-time high just recently. Now, this demand is expected to continue and to outpace construction. At the current pace of new construction, it will take over a decade to fill the housing shortage. So to summarize here, the housing market today in many markets across the US is experiencing a significant shortage of supply, and this is likely to stay with us for years to come. Further, over the next few years, it's forecasted that there's going to be 4 million new households created as many millennials are entering their early 30s. Now, this accelerated household formation is really only going to put more pressure on the demand for housing. Now, even with today's record low interest rates, recent estimates are that 75% of Americans cannot afford to buy a home. Rising home prices have put additional pressure on affordability, really making home ownership out of reach for many Americans. Now, the imbalance between low supply and high demand that we're discussing, specifically for housing and affordable housing, has been exacerbated by COVID. We've seen an acceleration of a surge for quality of life, a migration where many Americans are moving. They're moving from places like New York, California, and Illinois, and in record numbers, and they're seeking out lower cost markets with a high quality of life. A lot of these markets you can see on the screen here are in green, and they are experiencing rapid population growth, which is projected to continue through 2025. So today we have a housing supply shortage, housing demand extremely high, and we have high net in-migration. This is causing markets to experience significant rent growth. Now, this is a very important tailwind that the market is providing investors. And this chart really summarizes a lot of the cities that are experiencing this high rent growth. Now, as the next slide will show you, asset prices are at all-time highs. And rent growth, in our opinion, is essential today in creating attractive returns, which is why we target many of these cities here for investment. So today's trends and continued positive performance through COVID across many commercial real estate asset classes has resulted in a surge in investor demand, really for quality assets that provide positive yields. Now, asset prices continue to increase, which you can see on this chart here in blue. And corresponding cap rates for commercial real estate in orange have and continue to decline really since the Great Recession. Now, in many of the markets that we focus on, the assets are selling in the low 3% cap rate range today. And we actually anticipate this is going to decline further. So what do? We have some great tailwinds, but properties are very expensive today. Now, we've been value-add investors for over 15 years. The market today is giving us very attractive tailwinds and rapid natural appreciation. We believe it's a great time to be investing in affordable housing. So how do we protect ourselves and reduce risk? Well, we rely on sound underwriting assumptions and formulas. And at SMK, we focus on downside protection and partnering with expert operators. And if deals don't meet our stress tests, then we just won't invest in them. So let's review a few of our assumptions. Number one, We focus on manual rent growth, primarily through renovations and value add. And when projecting future rental rates, we pad the numbers. Number two, we focus on markets that have natural rent growth. And when we project these future rent growth assumptions, oftentimes for markets that are experiencing 5 or 6% rent growth, we'll only build in half of that, 2 to 3%. Number three, on floating rate loans, we build in interest rate increases, and we just assume that interest rates are going to go up each year. Number four, we build in cap rate expansion, typically of 100 to 150 basis points, and assume that cap rates are going to go up. Now, I don't personally believe that cap rates will expand that much in the near term, but we build this into our model really for added downside protection. Number five, we ensure that investments can absorb north of 25% economic vacancy, even in markets that have a history of decades of average occupancy over 90%. And number six, many of our apartment deals are underwritten as if we're going to renovate all of the units. Now, this isn't always really realistic. Oftentimes, once we've renovated 20 or 30% of the units, our operating partners have then proven the business plan, and we can leave some upside for the next buyer. And there are a lot of buyers and investment groups that love to buy properties where they can finish the renovation, and they'll often pay a premium for this reduced risk. So today, we want to take advantage of the strong tailwinds that the real estate market's providing us. And by underwriting and assuming conservative projections, we can help insulate our investments from potential changes in the market. But if current market trends continue and our assumptions are overly conservative, then we have set ourselves up to outperform, which is the end goal. So I really don't know how much longer these market tailwinds are going to last. We do feel that we have a short window of time to invest in a meaningful way before things probably slow down and our investment environment becomes less fruitful than it is today. So I hope you found some of the trends and our strategy helpful. Please feel free to reach out with any questions. Thank you.